Okay. Yeah, all right. So today we're very pleased to have Professor George Skiadopoulos. He's professor of finance at the Department of Banking and Financial Management at the University of Pyrrhus and the School of Economics and Finance at Queen Mary University of London. He's also director and co-founder of the Institute of Finance and Financial Regulation and an honorary senior visiting fellow at the Business School, formerly Cass City University of London. So his bio is quite extensive, and I don't want to cut into his time by reading all of it. It was in the email that was sent inviting you all to this, so I urge you to read it for yourselves. And with that, I'd like to turn the floor over to Professor Skiadopoulos, who's joining us from Greece.
Thank you, Peter. Thank you very much for the kind introduction and for the invitation. Please feel free to interrupt me if you have any questions. I'll try to finish in time, and please let me know when I have about 10 minutes to go so that I don't abuse your time. So this is a joint work with Kazuhiro Hiraki, who is in the Bank of Japan. And as you can tell from the title, the paper is in the intersection of asset pricing and options. So in particular, in a nutshell, what we do in this paper is we come up with a way of estimating the effect of frictions to expected asset returns, expected stock returns in particular, by using information from option markets. So let me give you a brief appetizer. The keyword here in this presentation is what we call CIFR. So CIFR stands for the contribution of frictions to expected returns. So it is an acronym. And what we're going to do in this paper is three things. So first, we're going to define CIFR and try to motivate you why it is important to estimate it. Then how are we going to estimate it? That's the core of the paper. And then we're going to apply it to actual data and see how the empirical properties of CIFR tie with properties implied by some formal asset pricing model. So here is a figure just for three stocks: Apple Computer, Coca-Cola, and New York Times stock. And you see the CIFR for each one of these three stocks. So each stock has its own CIFR. You see that it takes both positive and negative values over time. And also you see that sometimes you have spikes. So we're going to discuss these properties as well as some more over this paper.
What does %PM stand for?
Sorry, so this is per month.
Oh, okay. Thanks.
So you will see that CIFR has actually the notion of an alpha, but I'll come to this. So in a frictionless market, so in a market where you have no market frictions like transaction costs, short selling constraints, margins, and so on, then we know from standard asset pricing theory that the expected excess return of an asset I is given by what we call the covariance risk premium for these assets. So the covariance risk premium is defined to be the covariance between what we call the stochastic discount factor and the return of this particular asset. So this is the standard, if you like, CCAPM model, the consumption capital asset pricing model. But when we have market frictions, then we have an additional term, which is what we call CIFR I for asset I, which is added to the compensation that the agent requires when the agent is exposed to some systematic risks. So the covariance risk premium is the compensation for the risks that you are exposed to, and the CIFR component comes to cover any costs that may be incurred by market frictions when you trade the asset. So why is it important to estimate this CIFR? So obviously CIFR is unobservable. And the estimation of CIFR, we argue that it is important because obviously it is going to capture the effect of frictions. So it's going to reveal the impact of frictions to expected returns. So you can think of this as a frictions alpha, there is a paper by Garleano and Peterson where they have margins in their model, and this additional component is what they term the margin CAPM alpha. So we'll come to this interpretation a bit later. Also, once you have estimated your CIFER, then you can do some reverse engineering and you can relate it to some well-known proxies of market frictions, and then possibly you can identify what the dominant frictions in the market are. And finally, there is some literature which discusses how you can distinguish between the estimated average returns and the true expected returns. Typically, the estimated average returns are going to be contaminated by the effect of friction. So there is literature by Bessenbinder and authors on this.
Do we think of frictions as exogenous here? Like, so, you know, in some market, there's some given frictions and we just know them, or are they somehow themselves determined endogenously from something else? I don't know.
So yeah, that's a good question. So we regard frictions as exogenously given here. So you, in the model, as you will see, we model them as some sort of constraints to portfolio allocations.
Okay.
So regarding the previous literature, typically the previous literature estimates CIFER by checking the alphas of portfolios constructed on backward-looking proxies of frictions, or by posing some assumptions on the dynamics of frictions and preferences.
George, this is Leon. Can I ask you a question, please?
Sure.
About this slide. So if I look at the actual data, historical data, then what I sort of see by comparing, let's say, you know, taking the average excess return, I see the combined effect of like the pure covariance and the CIFER component together. Is that correct? So the
Correct,
data will represent both, essentially.
Correct.
So I can't really, it's not obvious how to extract the pure covariance risk premium, right? Is what you're sort of saying, right?
So here we're not going to deal with the covariance risk premium. We're going to focus on this CIFER component.
Yeah. Okay, I have a related question. So just back to the very first bullet point. I mean, is it not just, I'm thinking it's not just a frictionless market, but it's also a quote efficient one, so that there's no alpha, because let's say you're implicitly saying alpha 0 in the first equation, aren't you?
Yes.
Okay. Okay. So in the presence of inefficiency, one could potentially confuse alpha with either the CIFER or the covariance risk premium. Then, is it
correct?
Yeah.
Correct.
Okay. Okay. Thanks.
Yeah. So what we do in this paper is the following. We will try to convince you that if you scale properly deviations from put-call parity, then this estimator is going to estimate CIFER accurately. We're going to do this by means of an identification strategy, which is non-parametric. So we're going to let the data decide on whether the proposed estimator is a good estimator for CIFER. This estimator obviously is using information from option markets as well as from the underlying asset. So the estimator is going to be forward-looking, and it's going to be model-free in the sense that it's going to have no free parameters. And then the beauty of this estimator is that we can set it in a formal asset pricing model, and we can derive testable predictions about the relation between CIFER, alpha, and market frictions. Then, once I hopefully convince you about the accuracy of the estimator, we're going to estimate the CIFER for each optionable US stock, and we're going to study their properties. We will see that CIFER can become sizable even for large optionable stocks. So it's going to have a significant variation between -14% and 11% per year. And Then we're going to study the variation of CIFAR with well-known proxies of market frictions and stocks characteristics. And we're going to explain these patterns by means of a simple asset pricing model. So let me briefly set this work within the related literature. So there are two streams in this literature. There is an agnostic approach, as we call it, where people typically develop some reduced form models. So by this, I mean that you make no assumptions about what kind of friction you have. Instead, you say, assume that there are some frictions and you try somehow to estimate them. So this is like a black box approach, and our paper actually speaks to this literature. So there are two nice papers by Brennan and Wang and Howe and co-authors on this. And more generally, as you may have already gathered, we're going to use here violations of the law of one price. So deviations from put-call parity is such an example. And in principle, these violations reflect the effect of friction. So within this vein, you have papers by Garleano and Petersen or Pasquariello. They do not examine deviations from put-call parity, but still the spirit is similar. Then there is literature where people postulate specific market frictions and they try to see what is the relation of them with future stock returns. So you have, liquidity, short sale constraints, leverage constraints. Then we have a specific literature on violations from put-call parity and how these violations predict future stock returns. In this literature, you have typically two general types of explanation for why put-call parity, deviations from put-call parity predict future stock returns. One is the so-called informed trading view. So why, if you have a violation in put-call parity, this is going to say something about future stock returns because informed traders trade in the option market and their expectations are then diffusing to the underlying market. And then you also have another explanation where there are frictions which cause these violations from put-call parity, and because of these frictions, then you have these predictability patterns. As you will see, we also document that our predictor predicts future stock returns, as this previous literature has done. So in a way, this is not surprising, but we go well beyond this literature by explaining, for instance, the size of alphas that people find when they do these cross-sectional predictability exercises. And we set these within a formal asset pricing model. Finally, and this relates to probably to your previous questions, there are some very interesting papers which deal not with the estimation of CIFAR, but they deal with the estimation of the covariance risk premium term using information from option markets. So these are the papers by Ian Martin and Christian Wagner and Kaydan and Tang. So in the remaining, I'm going to describe now, our estimator and why it works, then the data set, the empirical analysis, the theoretical model, and testable implications, and finally, we're going to conclude. So let's define S tilde to be the so-called synthetic stock price. So this is the price of the underlying stock that we synthesize by taking positions in a European call and the European put option plus some cash, if you like. And in the absence of frictions, we know that the stock price is given by this simple expression where M star is the stochastic discount factor. So this is under the P measure. And this ST should be equal to the synthetic stock price S tilde. But In the presence of frictions, we have now something else. So our equation 2 is transformed to 3, where now you have this wedge term omega. So omega captures the effects of frictions in the underlying market. And also, of course, you may have frictions in the option market. And now we denote these frictions by omega tilde. Okay, so these two components, these two wedge terms, are going to be key in our subsequent discussion.
Just a second, can you go back a second?
Sure.
So the in equation 4, you were saying the options market. When I look at, so it's like, I know what you're saying. You actually mean it's the underlying implied from the options market, right? That's what you mean by 4. So you're not talking about actual option prices because you're using S tilde in 4. So your 3 and 4, they're looking at the same assets, say Apple stock. One is, 3 is direct trading in Apple stock and 4 is synthetic trading in Apple stock using options. Is that right?
Yes, correct.
Okay. Because
so
I'm thinking, well, just because I'm thinking like there's, in 4, it's frictions due to options on Apple stock. And let's say, especially because you're both buying and selling the option at different options, like buy, call, sell, put. You're going, I mean, can you tell me about, I know you got positive and negative frictions in the end. But let's say most of us think of frictions as only positive, let's say. So can you just explain how you get two signed frictions from these types of equations?
Yeah, sure. So your intuition is very good. So actually, maybe I'm a bit, maybe I should say this a bit later, but so as you will see, what we try to do here is the deviations from put call parity obviously reflect frictions in the underlying market as well as frictions in the option market. So what we will try to say here is that our estimator is going to reflect only omega and not omega tilde. Now, coming to your question about how come we have some sort of negative frictions, you can think of this as, for instance, when you short sell an asset, right? So the investor would like to have a negative expected return there. And so you're exposed to the covariance risk premium, but also you would like, you have you also need to cover your short selling fee. So you would like to get a negative expected return, which covers both your covariance risk premium as well as the short selling fee. That's the idea. But maybe we can revisit this a bit later when you see also some more details.
I mean, my earlier point about like there is in general non-zero alpha in asset prices unless you have a perfectly efficient market at all times, is going to come in now, right? I mean, so even if all frictions are positive, the alphas can be of either sign. So so that let's say inefficiencies can cause one to calculate a friction that's actually negative when it's even in a world where it's only positive. Okay.
George, question, but the random variable S capital T, right? That also absorbs the effect of the frictions, right? Correct? I'm looking at like equation 3, let's say, right? Sorry, so what it means, I mean, so that the impact of frictions on the price is also manifest in the probabilistic attributes of that thing you're taking the expectation of, right? S of capital T, that forward-looking, that random variable, right? On the right-hand side of number 3, equation 3, right?
So indeed, actually, as you will see here, the way we model these, this M star, this stochastic discount factor is also going to be affected by frictions.
Okay.
We'll see this in the model a bit later.
Yeah.
If you bear with me, and then we can discuss this
All
further.
right. Well, one last point. Okay. So, I mean, it's just that, I'm hung up on these omegas can be negative. And so, but I know the S's cannot be negative. And I know that the magnitudes of things are such that typically, even if omega is negative, it's not going to bring us to a negative number, but for a penny stock, potentially it could, the way you're formulating things. So, so the thought is do a multiplicative formulation of frictions rather than this additive formulation in order to, guarantee the reality that stock prices are never negative. Okay.
So you're absolutely right here. I mean, as you will see, the way we set up the model in a way imposes this additive rather than a multiplicative form. But you're right that technically, here omega could have been, negative and much more negative than this term, leading to a negative price. So technically speaking, here we do not impose these constraints. In the model, you will have a positive, an additive here term. Maybe we can discuss about it there, how
Sure.
we could avoid this problem if possible.
Go ahead.
Okay, so taking equations 3 and 4 and transforming them in the usual way that we do when you have a consumption capital asset pricing model, then you can express 3 and 4 in terms of expected returns. So here 5 is about the expected return of the underlying asset, and 6 is about the synthetic return, the synthetic expected return. And you see that omega is related to R and omega tilde is related to R tilde. So now our estimator, we are going to define these scale deviations from put call parity as the percentage deviation between S tilde and S, and we multiply with the risk-free rate of return. So effectively, so this is the estimator. So S tilde minus ST represent the deviations from put call parity. And obviously, these can be transformed to X being a function of the difference between omega tilde and omega. So by just looking at deviations from put call parity, we cannot identify the size of omega tilde and the size of omega, but there is a simple identification strategy that can help us to argue that our estimator X can possibly estimate reliably only omega. So how can we do this? So consider, for instance, the case where the absolute value of omega is much, much greater than the absolute value of omega tilde. If this is the case, then 7 can be transformed and X will be approximately equal to this term. But now this term is what? Is this term here in equation 5, which says what? It says that if, for instance, our X predicts the underlying stock returns, but it does not predict the synthetic stock returns, this would imply that we have this case here. This would imply that our estimator captures the effects of omega. Okay, so we're going to go to the data and ask this question, apply this strategy. We're going to check whether our estimator X predicts cross-sectionally the underlying stock returns and whether it does not predict the synthetic stock returns. If this is the case, then this simple strategy implies that X really is about omega. Okay? So this is the identification strategy.
But just empirically, isn't the case that bid-ask spreads are wider in options markets than in their underlying? So
that's a very good question. And actually, this is one of the challenges. We hope that we're going to convince you about this. So actually, what we are going to show to you once we apply this strategy to the data we're going to provide an explanation about what Peter has just said. So in fact, our identification strategy does not contradict the well-known evidence that you have market frictions in the option market. So it does not invalidate this literature. We're going to show to you that the reason that we find that our estimator is able to capture omega is because we're using mid-option prices. So if we use mid-option prices and some averaging that we do, then by means of a standard market microstructure model, we can convince you that that our X captures omega. So the finding that, as you will see, that X predicts the underlying stock returns, but it does not predict the synthetic stock return, does not mean that we deny that omega tilde may be big. It's just that if we use mid-option prices in our estimator, then this estimator works well.
Okay, I understand now.
So the data set is standard, taken from option metrics. We apply a number of option data filters, and we end up with about 1,400 stocks in each month. So this is a sufficient number to do our tests. The way we're going to compute our estimator, so this is our estimator originally, right? So in principle, you can compute this for any pair of strikes and maturities in your options. And then what we do is, because in the subsequent tests, we're going to consider monthly stock returns, we're going to compute a constant maturity, a 30-day constant maturity X hat, as we call it. So we take, we go first and we take two maturities surrounding the 30 days maturity. And for any given of these two maturities, what we do is we compute this X bar. So this X bar is a weighted average of the X's computed for pairs of strikes and maturities, whereas weight we use the open interest. And then we're going simply to interpolate linearly as you do with VIX, and we're going to get the X hat. So this X hat is going to be our X, if you like, estimator for a 30-day constant maturity, where we have done this averaging across the individual X's for any given maturity TI. And since we're going to do various asset pricing tests, we also need data taken from CRISP and from CompuStat. So the first thing we need to do here is to see, what the identification strategy tells us. So to this end, we're going to check whether our X hat predicts cross-sectionally the underlying stock returns and whether it does not predict the synthetic stock returns. So we do something which is standard. So we form decile portfolios, where portfolio one contains stocks which have small values for X hat, and portfolio 10 consists of stocks which have high values for X hat. And then we take the usual long, short, zero cost portfolio. So we go long in portfolio 10 and short in portfolio 1. And we calculate the spreads post-ranking monthly stock returns. So we do a rebalancing strategy. And at the end, we're going to see what kind of alpha this strategy is going to yield. And we do the same thing.
Can I ask a question about the data?
Sure.
So in practice, since you're using individual stocks, isn't the options traded only American style?
Yes. So that's a good question. So I guess, Chris, what you have in mind is that here we're talking about deviations from put-call parity, which have to do with European options. That's I guess what you're asking. So correct. So we take these American option prices and we convert them to European option prices. So we take the respective European option prices.
Yeah, but what's
You
the
don't know
impact?
them, right? I mean, you don't directly observe the European single name option prices, right? So you must do some kind of, estimation of the early exercise premium to get to Europeans. Is that right?
Yeah. So we take the American option prices from option metrics, and then we use the Black-Scholes and we map them to European.
Yeah. So what you're doing is using an American pricing algorithm, you back out implied vol, then you stick that implied vol in the European formula. Is that right?
Yes.
Okay. So that's a well-known way to quote Europeanize American options that everyone uses in practice. But let's say it's not perfect, either. Okay, but go ahead.
Second alternative is just to leave out the options where the stock's going to go ex-dividend during the lifetime. But George, let me ask you a different question. You're focusing only on the outliers, portfolio 1 and portfolio 10. You're throwing away 80% of your data. You could do quintile portfolios, but why wouldn't you just do half and half? Use all of your data.
So thanks, Steve. So as you will see, we are using all portfolios. Here we're interested in checking the cross-sectional predictability. So we do the standard thing that people do in asset pricing. As you will see, we're going to use all of our data. And then the idea is that, this X is predicting cross-sectionally our stocks, even only if the average return and the alpha of the spread portfolio is different from 0. That's the idea in cross-sectional asset pricing tests.
Yeah, but Steve's got a good point.
They end
Like
up
even
throwing
if
away
you're
too much
doing
data.
the standard thing, I like Steve's idea, which is, instead of, as he's saying, instead of only having non-zero weight in those two extreme portfolios, you could just have the most weight in portfolio, be longest in portfolio 10, be shortest in portfolio 1, but have,
Yeah, so
the others.
you say to do half and half, as Steve said. Yeah, we can do this. I mean, we have also done with quintile. I don't think the results do not change. We can do this as a robustness test. The results are not going to change. So let me get to the next slide, and then where we will have the full picture. And regarding the synthetic stock returns, we do the same thing. We compute the synthetic stock returns from this simple expression, where here we have the estimated X hat. So here is the full picture with the 10 portfolios. As I said, we have done it also with 5 with quintile, but as you correctly say, we can also do it with half. It just, we follow the convention that, in these asset pricing tests. So what you see here is our spread portfolio, the 10 minus 1. Here is the average return per month is 1.64%. Here is the T-stat. So these figures obviously are very large, and I'll come to this. And here are the alphas computed from various, models as a robustness test. Again, you see that alphas are really big and the T-stats are really big. So coming to the T-stats, the fact that they're really big is good news for us, because they address these data mining concerns, and people like Harvey propose using T-stats, with critical values greater than 3. This is providing convincing evidence that our results are not due to data mining. Now, people also have, and you may rightly say so, how come and you find so large alphas here? And in the theoretical model, we're going to show to you that these alphas, even though they seem to be excessively large, they're fully consistent with the size of transaction costs, for instance, that market makers or investors face in the market. So in a nutshell, what we find here is that this X hat predicts cross-sectionally the underlying stock return, whereas if we switch now to panel B, where we do the same exercise for the synthetic return, here you see that the average return is significant, even though the T-stat is not above 3. But then once you take the alphas, these are insignificant. So in sum, this evidence shows that, you know, our identification strategy tells us that our X hat captures omega and does not capture omega tilde. And just to ensure you a bit, we did further robustness tests on this predictability, you know, by controlling previous month's return, non-synchronous trading, small prices, and alternative breakpoints. The results are there. But as I said, in a way, I mean, you can rightly argue that this is not novel in the sense that previous literature has also documented that measures of deviations from put-call parity predict stock returns. But now I think it's going to become obvious that our paper is not about this. I mean, we go beyond this literature. This predictability is used just as part of our identification strategy. And I think we're the first who are noting that, look, you can use these deviations from put-call parity if you scale them properly for the purposes of estimating CIFER. And we're going also to provide the theory which justifies why you have this predictability here. Okay, the scaling, even though it seems to be trivial in a way. So if let me, so here.
George, before you go on, can I ask a question about the table you just showed us?
Sure.
It looks like the numbers, the returns. You're going backwards, forwards? That one, yeah. Now, I'm looking at the average returns in the cross-sectional pattern you're talking about is definitely there, but the actual returns for the synthetic predicting its own returns seem to be quite high all across the board. Am I misreading this? I mean, it seems like there's a lot of predictability here of the synthetic predicting its own return.
Well, indeed, there is here predictability, but then, you know, this predictability washes out if you take if you control for, you know, for other risk factors. So if you control for other risk factors, the predictability goes away.
Yeah, okay. Okay, sorry.
So I was saying that this scaling, even though it seems to be trivial, actually it serves a very important purpose, because theoretically it will allow us to relate these X hat to expected returns, because effectively by dividing with these S, we translate everything in returns terms. Also, the nice thing about this is that, you know, this omega relates to these expected returns through this simple sort of speaking expression. And this has a nice testable prediction. We can rewrite this in a regression setting, in a simple regression setting, where we proxy this covariance risk premium by a set of factors, any kind of factors you may wish. And then basically we have the following testable prediction. If X hat really is about capturing omega, then from this simple regression, what we should get is that these alphas should be equal to 0 and gamma should be equal to 1. Okay, so let's see what we get. So here we have approximated this covariance risk premium with alternative risk factors, the Fama-French-Carhart factors, or the Stambaugh-Yuan factors, or the Howe et al. Q-factor model. And we run this regression. And here, basically, this is the null hypothesis. And you see that we cannot reject it. Okay, so this is additional evidence that our X hat really captures this omega. Now, coming to Peter's very valid question, how come, and you know, what's happening with the W tilde? We know that W tilde exists, frictions exist in the option market. And what we argue here is that our simple estimator is able to capture this CIFER because we are using mid option prices and averaging in calculating this X hat. So we can show this by means of a standard market microstructure model, which has also been used by people like Muraviev. So what we saw, I'm not going to spend time on this, I'm just giving you the sketch here. we saw that if you use mid-option prices, then this mid-option price is approximately equal to the option price where you have excluded transaction costs. So the call and put option prices without transaction costs are given by equations 13 and 14. And basically, the model works as follows. We model the bid and ask option prices as the sum of these option price excluding transaction cost plus the standard components of the bid-ask spread, like the adverse selection part and the inventory risk part, plus an error term. And the nice thing with using mid-option prices is that these make these components to go away. So if eventually you're left with just this sum, and we show by means of simulation where we calibrate the parameters of the distribution, we assume a uniform distribution for the error term, we show in the appendix of the paper that the size of this error term is negligible. Okay, so I don't know if this is convincing, but in a way, this is a way to say that, you know, Rx hat does not contradict the evidence that, you know, there is a W tilde, but it just, this W tilde, our estimator manages to go away because we're using these mid-option prices and averaging. And that's why the identification strategy proves the estimator to be estimating CIFER accurately. Okay, I think I have another 15 minutes. So let me briefly show you now some results about what is the relation of our X hat with well-known proxies of frictions. So what we're showing here to you is, again, these 10 portfolios. We have the average CIFER for each one of these 10 portfolios. So we go from the lowest to the highest by construction. And then what we did was for each one of these portfolios, we looked at the stocks in these portfolios, and we computed measures like, for instance, the average bid-ask spread or Amihud measure or the size and so on and so forth. So various, you know, quantities which have been used by the previous literature to proxy frictions. And for instance, if you look here, you see that that portfolios 1 and 10, which have the most extreme CIFER values, also have the highest average bid-ask spread values or the highest Amihud measure. Okay, so this basically tells us that stocks with higher frictions exhibit more extreme CIFER values. Okay, so there is a U-shaped relation, if you like, between CIFER and proxies of frictions. Furthermore, what we did was we ran standard Feynman-Macbeth regressions of CIFER on frictions. We find significant relation between these, between CIFER and the frictions, and this is a further evidence that, you know, this CIFER actually is a meaningful estimator of frictions, because if there was no relation between CIFER and frictions, then obviously you would argue that, look, your CIFER is not really about frictions. Now, if we eyeball a bit, you know, our CIFER, how it looks like here in this figure, what we're showing to you is the interquartile range of this CIFER. So this interquartile range is another estimator, if you like, of the variation of CIFER. And basically what we see from this figure is that over periods of market turmoil, this variation of CIFER spikes up. So we have the Russian crisis or the collapse of Lehman, the European debt crisis, or turmoils in the Chinese market. Okay, and the other thing that we notice here is that over time, it seems to be the case that this variation of CIFER tends to decrease somehow. Okay, and in a way, this is expected because, you know, over the recent years, we tend to think that frictions in the markets in general have decreased, using automatic trading systems and so on and so forth. So this means now what? That if we were to check again the predictability of CIFER over more recent periods of time, this predictability should be smaller, because remember, CIFER is, you can think of CIFER as the alpha of your strategy. And in fact, what we did was we did a subsample analysis, taking December 2006 as a splitting point. And here you see again the average return on alpha for the spread portfolio before 2006. You see the predictability is there again. Now, if you look post 2006, again, you have predictability, but now, as you can see, this predictability is of a smaller degree in a way.
So you're saying the crisis is of 2007 and 8 is what caused you to split at this time?
Yeah, well, that's, that's one thing. The other thing is more academic in a way. There is this paper by McLean and Pontiff, which argues that, once you have publications of academic articles of measures which have been shown to predict stock returns, then this predictability goes away. So the interesting thing is that the studies which were first talking about the predictability of deviations from put-call parity appeared around 2006. So that's another reason we chose this. So in a way, these results are also in line with McLean and Pontiff study.
Okay.
Let me, in the interest of time, since I have another 10 minutes, let me briefly show to you the model. The model is very simple, as you will see. So it is, we have a finite time horizon. We have the stock. We have one period call and put options, which trade across strikes. And we have an agent who trades in both the stock and the option market. And here we have the positions of the trader in the various assets. And we tend to think of these market frictions as constraints on the agent's asset positions. So
theta zero in the riskless asset is
yeah, so theta zero is the riskless asset.
okay. Good.
And then this agent maximizes the lifetime expected utility subject to these GL, where GL are these general type of constraints on the positions theta of the agent. So these basically reflect the constraints posed by frictions. So we do not specify in advance what kind of frictions we may have. We leave this as general as possible. And then we have the standard process for consumption and for wealth. And the interesting thing here is that we have an extra process for the transaction cost. We differentiate, we add this extra process for transaction costs because if you think about it, transaction costs are incurred whenever the trader changes the position in the asset. So the transaction cost is about delta theta. It's not about theta. So that's why we're modeling separately these transaction costs here. And eventually what it comes up, and now this also speaks to the previous question by Peter about why we do this wedge term in an additive way and not in a multiplicative way. So in this simple general asset pricing model, this theorem tells the following, that the expected excess return is going to be given by this CIFER component and this covariance. This is the covariance risk premium component. The interesting thing here is the following. Oops, sorry. If there are no frictions, so CIFER is 0, then we go back to the standard CCAPM model. Second, CIFER does not have to do with this M star, with the stochastic discount factor. Okay, so it does not represent compensation for risk. And finally, so this relates to another question posed previously. You have some effect of frictions to M as well, to M star as well. Why? Because this M star depends on theta, on the asset positions.
Yeah, quick comment. I mean, the statement CFR does not depend on compensation for risk is because you're taking CFR as exogenous. You know, a market maker who's trying to decide on the size of the bid-ask spread, there's plenty of models that say the bigger is the variance of the underlying, the bigger the spread they're going to choose, right? So you know, so that's, I just want to clarify why that second bullet point from the bottom is accurate.
Yeah. So you're absolutely right, Peter. Here we assume, you know, that we have this sort of exogeneity. So in a way, when we first started working on this paper, we were motivated by the paper by Garleano and Peterson, where they were looking at a specific type of friction that was the margins. And they have a similar sort of model where here they also have, you know, a term which is an additive term, and they call these the margin CAPM model. So that's why your point is very fair. It's just that, you know, we have taken the approach of starting with something which we thought that would be as simple as possible. And then, you know, if people got interested in that, maybe they could, you know, generalize it.
Okay.
Okay, so finally, in the remaining 5 minutes, the model provides another nice proposition, we think. So basically, the proposition is about the range within the CFR values may lie. And as you can see here, the bounds are determined by this rho, which is the proportional transaction cost, and this zeta, which is the short selling cost. The maximum width obviously is 4 times rho plus zeta. So what this simple proposition tells us is that first, CFR can take both positive and negative values as we find. Second, if you have larger frictions, then obviously the variation in CFR is going to be greater. As zeta increases, then CFR becomes more and more negative. And finally, since CFR is about alpha, here this inequality provides us a bound for the alpha of the spread portfolio we were talking before. So this means what? This means that if we had values for rho and zeta, then we could get the maximum alpha that this long-short portfolio strategy can earn. And in fact, there is some literature, fortunately, which has provided some values for, you know, 2 times rho, about 1%, and zeta 0.1%. So which means what? That effectively, the CFR of this long-short portfolio can reach up to 2%. So the alpha can be up to 2% per month, which is fully in line with the results that we find in the long-short portfolio. So in other words, what we try to say here is that when people, you know, have doubts about how come we have so strong predictability in the cross-sectional exercises, our answer is that based on this simple asset pricing model, you know, the alphas that we get are consistent with the effect of frictions that that investors face in the market. Okay, I think that's an interesting question, and I guess it's up to professionals, you know, to really see whether the alphas that they get, after all, from this simple strategy is something that they can, you know, exploit, or is just you know, goes away. Okay, so to conclude, I think I still have two more minutes. what we hope that we're doing in this paper is to provide a novel model-free forward-looking formula to estimate CFER. In particular, we have shown that scale deviations from put-call parity estimate CFER accurately. We have developed them within a formal asset pricing setting. And the advantage of doing this is that we can now pin down the relation between CFER alpha and frictions. The alpha of the CFER sorted spread portfolio is large, yet it is consistent with the degree of market frictions. Once we took the estimator to the data, we saw what is the relation between frictions and expected returns. So CFER can be sizable even for big optionable stocks. So, this may be surprising, but that's at least what we find. People think that, optionable stocks are not subject to market frictions because they are big. Still, however, there are market frictions even for them. And there is a U-shaped relation between CFER and proxies for transaction costs. This is, I think, I didn't speak about this, but this is very interesting in light of the literature, which shows that many anomalies go away if you concentrate on big stocks. So, the tendency seems to be in asset pricing nowadays that, these anomalies are coming from the small cap stocks. But given this U-shaped relation between CFER and proxies for transaction costs, this is not surprising, because if you think about it, when you sort stocks on a proxy for transaction costs, basically what you do is, remember, the stocks which have high transaction costs also had excessive values for CFER, both negative and positive. So when you mix together stocks which have high transaction costs, you mix together stocks with positive and negative CFER, so positive and negative alphas, and that's why eventually you find that the alpha of your portfolio is zero. That's at least an explanation that we give. And finally, we believe that, our humble view here is that, if you believe in this estimator of market frictions, then you can start revisiting the whole literature, which uses information from option markets under frictionless markets, under the frictionless assumption, to study a number of questions. So in particular, and with this I'm going to finish. So hopefully, if you're interested, we can talk about this in another seminar. What we're currently working on is to revisit the Baxi-Kapadia-Madan formulae for computing risk-neutral moments. So these formulae have been developed under the assumption that you have frictionless markets. We have revisited them. We have modified them by taking into account the CFER. And then we find, some interesting things. Let me show you just one, and that will be the end. There is a big literature about documenting that the risk-neutral skewness predicts stock returns. And you can show this, by sorting stocks according to the risk-neutral skewness of each stock. So you do this exercise, and then you take the spread portfolio again, average returns and alphas, and you find that the alphas are different from zero. So for instance, here, if you look here, we have value-weighted portfolios. We have sorted stocks according to what we call ORNS. So ORNS stands for the original RNS, so for the RNS computed from the Baxi et al. Formulae. And indeed, we find this predictability that has been documented by the previous literature. So the average return of the spread portfolio, is significant. So are the various alphas. But then, if you take market frictions into account and you come up with a new formulae for the risk-neutral skewness, that's what we call GRNS. So the GRNS is computed as a function of CFER. Then you see the very interesting thing. The predictability goes away. Risk-neutral skewness does not predict stock returns any longer. Okay, but that's for another paper. I just wanted to give you something to think about and possibly discuss about it. So that's all I had to say. Thank you very much for your very interesting questions and for your attention and time. Thank you very much.
Okay, thank you, George. All right, we can open it up if, like Armand, I know you sent a message. Maybe you could just repeat it.
Yeah, I would just, I guess I sent it to George. I said about what's happened with GameStop and the options market. It's changed quite a bit of the way people now are pricing some of these call options, because they've been probably people realize that they've been underpriced, given the what happened in January, and the smile has changed quite a bit. So you can see with the VIX, where it used to be where the puts are always usually been overpriced versus calls. Now it seems to be almost even. So I was wondering if this would change some of your analysis, given the structure is somewhat changed of the options market. So it's interesting to see if that's something which could be, if you have any thoughts on that.
Yeah, that's, I mean, our data, stop at around 2016. So we have not really, touched on this, but obviously, it's easy. We can extend and see, and
Yeah,
see.
because I think a lot of the relative put call, in terms of the valuations of these things, the market's different somewhat, and so not every across the board, but the market has we realized that there were problems with pricing of a lot of these options were mispriced because they were too cheap, or they weren't being hedged correctly. So it's a good sort of intro, because the analysis is good. It could be interesting to see if there's any, how it relates to what's happened to the market. So that's something maybe you can see in terms of going forward as extension of this. But it's an important part, because the market has changed somewhat.
George, I got a question for you. For the most part, when we're doing option pricing, we don't pay much attention to the riskless rate, because riskless rate is, it's not that important for short maturity options. But when you're doing put call parity, it becomes really pretty important. And I've always wondered about this, where it seems to me that the relevant riskless rate should be, what is the opportunity cost of funds to a guy who's going to do the arbitrage? And it might be very different whether you're buying the put or shorting the put. And it's not obviously going to be the T-bill rate or anything like that. This is an exploration I've always thought somebody should do, and I don't know that anybody has done it, but it certainly affects your thing. I was going to preface my comment, but I want to post preface my comment and say I really like what you're doing with this. This is, I think, really interesting work, and I particularly like the idea that you talked about at the end of trying to incorporate this into, differences between the options market and the stock market into the Bakshi, Kapadi, and Madan things. But a long question, but how did you think about the riskless rate in this, and did you do any kind of exploration of alternatives?
Yeah, you're absolutely right, Steve. Thanks for the comment. Actually, that's a very valid comment. No, we did, the standard, we took the risk-free rate from Option Metrics. So, but if you have any suggestions, I mean, how one can estimate these opportunity costs for the arbitrage, that would be something very interesting to look at. I don't know how to measure these opportunity costs, to be honest.
Yeah, I don't have any obvious thoughts off the top of my head, except go ask somebody who does it and find out what they use.
Wait, Stephen, are you talking about
I'm not going to go and do a delta hedge with the same expected return as on a treasury bill.
I mean, Steve, the point Steve is making is a question I can tell you a little historical story about this, right? Go back to, let's say, when rates are normal levels, right? And you're trading treasury options on the 10-year note is special. Repo rate is 300 basis points below the general collateral rate. You go to a trader, say, listen, suppose you write a call. You delta hedge the call by buying the 10-year note. It's expensive to borrow, right? So
Mhm.
once you establish your hedge, you can lend it out and borrow money to let you. So what rate do you expect to earn if you perfectly hedge your vol risk and your price risk? Do you expect to earn the repo rate of that underlying asset, or do you intend to earn the generic riskless rate that prevails in the market for the holding period, right? I mean, it's sort of similar to what Steve was just asking,
I
right?
think,
I mean, what rate is,
I think you would,
yeah, what rate is manifest in that
I
trade?
think you would maybe let's use the term repo for that period is the best guess.
I would think so. Yes, that would be the guess, right? You could
So
lock
the-
in the term repo return. Yeah,
That
right.
the same thing you use for an analysis here. If you're options market maker, you would take the term. I mean, I guess it'd be more like term LIBOR in effect, something like that, right, Steve? Like a term LIBOR rate.
I don't know. I'm thinking about what Leon was saying is, well, suppose you've hedged out all of the risk, then what rate of return? But
Exactly, right.
I can't hedge out all the risk, and so I want some compensation. It may seem that for marginal changes of the stock price and volatility that I've hedged out the risk, but non-marginal changes happen all the time, and then I'm going to get screwed if I'm short these things.
Right.
So, I want more compensation than just a T-bill rate or the repo rate, because I know I can't hedge out all those risks.
Yeah.
And when it comes to hedging, doing a put call parity arbitrage, then I'm not sure what other risks there might be. I mean, you could get margin calls, you could get all kinds of annoyances. And I want some compensation more than T-bills. More than the option metrics riskless rate.
Well, I think a lot of problem is that a lot of these market makers and options really are not even hedging their exposure sometimes with these out of the money options. So I mean, in some sense, you're right about the return, but a lot of them are just taking just risk that's not even being hedged with the actual stock. So you're talking about sort of very unscientific way that a lot of these market makers are doing their options in the first place. So you're right about that. There's the measure, what kind of return do you want on top of if you had a hedge portfolio to begin with, right? If you want to do a hedge portfolio as opposed to just taking an unhedged position in the option because it's so out of the money, you're not going to hedge it, which would happen in January for a lot of these market makers.
George, I wanted to ask you a question. In Europe, hedging actual European options in Europe, do they use negative interest rates for negative numbers for the riskless rate?
I think they simply zero them out. I don't think that they are using negative rates.
Right.
Okay. All right. We should wrap up. So thank you everyone for joining. Abby, you can stop the recording. And so we'll be back again next week. Hope to see you all. Appreciate your attendance today.